Stock market volatility. This is Ken Boyd. So I want to cover three key topics. How is stock market volatility measured? What has been the historical change in stock prices each year, which is important to know in this environment? And finally, consider your own personal risk tolerance, which I'll define for stock investing. So how do we measure stock market volatility? Well, the best way to do it is a stock index. And an index is a basket of stocks that are priced each day. And the most popular is the Standard & Poor's 500, which is 500 of the largest stocks that trade in the market. It's names Microsoft, IBM, etc. These are publicly traded, meaning that they are stocks that are owned by individual investors, and they are domestic stocks, meaning they're based in the US. How has the Standard & Poor's Index performed over time? Well, the average annualized return between 1926 and the end of 21 is about 10.5% a year. That's according to Investopedia. Now, that assumes that you take your earnings, dividends that you earn, and you reinvest your earnings. In other words, you leave any gains and losses from stocks and dividends earned inside the portfolio, so you don't take money out. Now, here's the important point. What about year-to-year fluctuations? This chart shows the year-to-year fluctuations, and this is the big point because you can see that we've had increases as high as 30% or more, and we have had decreases as much as 30% or more. Here's the tech bubble burst in the early 2000s. Here's the mortgage crisis. Here's during the pandemic. So the point being is that while it averages 10.5% a year, the fluctuations from one year to another can be enormous. So what do we do about that? Well, you need to ask yourself, what is your personal tolerance for risk? Answer this question. If your portfolio declined in price by 20% in a year, is that something you could live with? If that's too much, how about 10% a year? And your answer determines what percent you invest in stocks and also the types of stocks that you buy. Utility stocks, for example, have less fluctuation because everybody pays for utilities and they have reliable earnings and revenue. As a result, the stock price doesn't fluctuate as much. It's important to consult with a financial advisor regarding the risk and rewards of stock investing. And for more great information on accounting and finance, you can go to conference room at this address.